the crypto network that came out of Facebook, but I'm also on the foundation as well. But I actually put most of my liquid net worth into that. And then I own a lot of digital art on Ethereum because that's a long-term store of value for me.
NFTs?
NFTs. And so I've moved around a lot between, Bitcoin, Ethereum, Solana, and Sui. I don't trade. So these are long-term holds. I might change once every 2 years, change my allocation. But it's generally all the big tokens.
Hey guys, welcome to Everyday Finance. The key to what occurs next in cryptocurrency, according to macro investor Raoul Pal, is liquidity's return to the forefront of markets. According to Pal, the creator of Real Vision and a former hedge fund manager, we are about to reach the second stage of what he refers to as the banana zone, a time when robust increases in risky assets are driven by fresh liquidity. In order to restore its general account, the U.S. Treasury has been issuing bonds in recent months, which has temporarily depleted the system's liquidity. That action put pressure on markets, particularly in the cryptocurrency space, which is why Bitcoin and other cryptocurrencies have been moving slowly and sideways. Many people questioned whether the surge was over as Ethereum and Solana both got close to their peaks before reversing course. Pal contends that this pause is a sign of readiness, rather than weakness. Capital is anticipated to return to cryptocurrency markets as soon as the Treasury completes its funding and liquidity starts to replenish, paving the way for the subsequent significant upswing. This might be a unique opportunity for those who can tune out short-term noise. We'll talk about why cryptocurrency has underperformed, what Phase 2 of the banana zone looks like, and the important indicators to look for before the next big rise starts.
I'm a huge believer in geographic location for a number of different reasons. So I've lived in the UK, India, Spain, and the Cayman Islands. I spent most of my working career on this side of the pond in the US. Spain is lifestyle arbitrage. The cost of living is even probably half that of the UK and a third of that what it is in the US or the Cayman Islands. 300 days of sunshine, incredible people, culture, climate, cost is very cheap, rent is cheap, to buy is cheap, everything. Perfect lifestyle arbitrage. Problem is network. You're not surrounded by people who are ambitious doing different stuff. In a globalized world now where we can work online, it's actually doable. So we're seeing a lot of Americans moving down to Latin America. That's the arbitrage here. Or Colombia as well. So into South America, Latin America, it's cheap, high quality of life, relatively safe. And if you're in a business where you can work online, okay, you can get to your end goal, your coast-fire thing super fast by doing that. If you want, to your point, if you want intellectual capital, there is only one place in the world that has it in such high density, it's the US. Capital and intellectual capital. Asia has it, India has it, it's all around, but they're all missing different forms of it. So it's using that for your end goals.
What about the UK?
I can't do it because the UK's attitude now has become, we just can't have nice things. They don't want to. If I speak to my friends, they don't want to invest. They just want to have the bigger house and the next car on lease. People are institutionally unhappy in the UK right now, and there has been for a while. And so we don't have a culture of entrepreneurialism left. It's been stamped out. Europe too. So it's not just the UK. Everywhere in Europe, the same thing has happened. People just don't believe they can have nice things anymore. I think it just feels like a backwater.
Backwater?
Yeah.
What's
it's an economic backwater. So don't forget, in the late 90s and 2000s, it was this entire center of the world's financial industry. It was the center of the world's advertising industry. It was some of the, all the creative industries. It was all based in London. We lost all of it.
Why?
Regulation.
So you think it's the government have misstepped?
Yeah, the government misstepped and the US took the banking system back because how they treated capital requirements in the UK and Europe was different than the US. And they managed to get the Wall Street back to Wall Street. It had all moved. I was working for Goldman Sachs. London was their biggest office. Same for JP Morgan, Morgan Stanley, everybody. And we just stopped it. And now we're seeing it again. We've got new industries rising. We've got AI, crypto. AI came out of Cambridge. I think it was, the Google DeepMind. I think it was Cambridge University for most of that stuff. And we dropped the ball. We dropped the ball in the finance industry. We dropped the ball in AI. We get this massive talent density coming out of Oxford and Cambridge, Imperial College and all these others. And we We don't use it. They all move to the US. We had the crypto industry, of which we were part of that. We dropped that ball too. We dropped the whole ball on everything. And Europe is actively shutting the door on every opportunity by saying, we don't want to do this. Don't forget, they're a nation of old people now, most of Europe. So they'd rather just not have any change. But if we go back to that economic formula for GDP growth, population growth is the key driver. You need a growing population over time, but it just needs to be done in the right way. So they're blaming that, but the whole economic machine is because nobody's had kids. That's the demographic problem is the structure of everything. And the problem is nobody's had kids, so you don't have economic growth. So then you try and bring in new workers to create growth. You don't want that, so they get thrown out. Meanwhile, the economy slows down. People get pulled back. They don't want to take risk anymore. The whole system is now having to pay for the National Health Service to pay for these old people. There's not enough kids to support all of that. The governments are getting more in debt. Bond yields are going up. Everyone's like, what's going on? It's all been a function of demographics from day one. Things educate yourself. You don't know, we talked about what do your finances look like? What's your bank account look like? What are you trying to achieve? Right. So you educate yourself, learn about investing, invest above all things. Investing above saving is the only way you're going to get there. Because if not, your money goes down. And then just do it. Make a trade, make an investment, fail, learn, do it again and do it again. And keep learning, educating, and then surround yourself by a good network. Just whether it's even on Twitter, on social media, find a network of people that you can learn from, add to the network, and those things you'll get ahead. You can't fail if you educate yourself. Just get started, and then learn, keep doing it, then, and just grow a great network.
And buy Bitcoin.
Obviously.
What coins do you own in crypto?
So this is going to get more contentious now. So I own just one Bitcoin for posterity's sake.
Oh, fuck. Okay.
So I'll
delete the episode then.
I own mainly Sui, which is the crypto network that came out of Facebook. But I'm also on the foundation as well. But I actually put most of my liquid net worth into that. And then I own a lot of digital art on Ethereum. Because that's a long-term store of value for me.
NFTs?
NFTs. And so I've moved around a lot between, Bitcoin, Ethereum, Solana, and Sui. I don't trade. So these are long-term holds. I might change once every 2 years, change my allocation. But it's generally all the big tokens. Crashing down how the system is rigged in the favor of rich people it's extraordinary because it's the Charlie Munger quote of show me the incentive and I'll show you the outcome. What people get once you get, it's not the 100,000, but it's like the people who've got 10 million in their bank account. They get loans that are called non-recourse loans. It's an extraordinary thing because unlike your friend, they don't have to pay it back. So a non-recourse loan means you're not legally liable for the loan in the end. Now, there'll be some provisions on how to do it, but why are they doing this? Why are they getting these favorable terms? Why are they getting the private placements in stocks before they go public? Why are they getting all of the best offers? Because they pay fees. Because they pay fees to the investment banks, and the investment banks desperately want these people because they have a lot of financial activity, and so they incentivize them. None of us get a look in at all of that. It's the same thing that I talked about with the hedge fund industry in the beginning. It's like they were incentivized via fees to get information that was better than everybody else. And I think part of that is the ability that all we're trying to say to people is you don't have to play the same game. You don't have to pay anybody's fees. You buy a Bitcoin, stick it in your Coinbase thing or wherever. It costs you nothing to run and you're outperforming a venture capital investor. There's simple things like buying an index fund. You're not paying the Wall Street complex thousands of dollars for active management. There's ways of hacking this, and it's not that expensive to do.
Raoul Pal's first significant realization is straightforward. The recent cryptocurrency dip was a brief liquidity gap, rather than a failure. Around $500 billion has been taken out of the system since July, which is what caused the erratic, sideways price movement of Bitcoin and other cryptocurrencies. The market was actually reacting to that significant reduction in liquidity, which is what seemed to be waning momentum. Pal anticipates that liquidity will return now that the Treasury's account has been restocked, spurring growth in all risky assets. He clarifies that this marks the start of Phase 2 of the banana zone. is typically characterized by robust rallies in both Bitcoin and other cryptocurrencies as market liquidity returns. From a wider perspective, Pal notes that the Nasdaq tech trend and global liquidity cycles continue to have a significant impact on Bitcoin's success. Although some anticipated a quick breakout, macro factors including interest rates, debt rollovers, and a stretched business cycle have slowed the pace. However, this longer 5-year cycle provides greater space for long-term growth rather than indicating weakness. Pal believes there is a unique opportunity for investors to position themselves before the next significant step higher. As key indicators like the ISM and interest rates indicate we are still in the early stages of the expansion, he then examines the indicators that might indicate that Bitcoin is once again outperforming tech equities and the reasons why. Altcoins might be preparing for big increases during this cycle.
The other way of approaching it is I never really solve for costs. I solve for income.
Okay.
And that is saying, okay, your lifestyle, as long as you're not being ridiculous, right? Is like, do I really want to not go to a restaurant or get that Uber Eats or whatever?
I understand, yeah.
Because that's penalizing yourself. And that's not a nice thing to do always, right? It takes a lot of discipline, and discipline is hard. But if you've got an opposite amount of discipline in solving for income, you actually move your lifestyle further ahead. So, the rise of, I do 3-4 jobs, you do 3-4, we all do lots of different things now. You do as well. We all got different income streams. You're almost better off to spend your energy thinking about how do I increase my income stream than your cost basis. At a certain point, we agree, like Stephen's friend who sent him the message, he needs to desperately rescue his cost base. But generally, if you're looking at a life plan, you'll get to your coast fire or whatever it's called quicker by solving for income than you will for cost. In essence, if you're Microsoft, they have huge cash piles. What does Microsoft buy with their cash? Really, they buy some investment stuff, but it's generally cash base. And then they may buy another company, or they may buy real estate, data centers, let's say, or they may buy their own shares back. All of those 3 things that they buy are driven by the debasement of currency, and they get more expensive every year, and they're holding a cash return of 3.5%. So it's stupid what they're doing, because actually all your shareholder cash is not buying the equivalent of the actual things that drive the value of the company.
So what about small companies? What if there's people listening now that have companies where they've got $1 million, $2 million in the bank? They probably don't need it all for cash flow reasons.
And so I do think that investing versus saving is misunderstood. To go back to your original question, I think investing is much more important. I made the mistake of being a saver when I was young because, the fear that, all of that stuff meant I was super risk averse, and I was an investment banker. I was investing, but I didn't. So I made money from being in that industry. So I'm like, I'm just going to hoard cash. I did worse for doing that. And then once we saw the banking system fail, I'm like, I'm not doing this anymore. I'm going to take control of my own finances. So the same is true of a business. If they're generating cash, they shouldn't be sitting on a massively large amount of cash, but some liquid investments, I think, massively help, because you're going to make your cash grow for you and your shareholders. And that's important. But don't let go of your liquidity, because when you really need it and you don't have cash, that's the worst thing in the world, particularly when you've saved the money.
So in your business bank account for Real Vision, do you put some of the money into crypto?
It depends. A lot of it gets reinvested for growth within the company. Okay. So you're making the decision how's your capital going to grow? Is it going to grow your share price via reinvesting in the business? Or is it better to use the savings pool and buy other investments and diversify away? That really depends on your business, where it is in the growth cycle. But if you're like a cash generating, regular non-growth style business, then you're going to be generating cash. You might have taken some dividends out and bought a house and done all that thing. Yeah, there's no reason not to do some relatively conservative investment strategy.
According to Raoul Pal's most recent research, cryptocurrency hasn't failed. Rather, it has been adapting to a brief liquidity crunch. About $500 billion was removed from circulation as a result of the Treasury's bond issuance and account top-ups, which caused volatility and sideways movement in Bitcoin. Ethereum, and other significant altcoins. Pal views altcoins' brief leadership and subsequent retreat as a healthy recalibration rather than a sign of weakness. He anticipates that markets will react forcefully once liquidity returns, providing the perfect environment for patient, knowledgeable investors. Pal emphasizes that the single most significant factor influencing asset performance is global liquidity. Liquidity trends account for 95% of the NASDAQ's gains and around 90% of Bitcoin's price changes. This implies that knowing where money is flowing is significantly more important than short-term noise like tweets, headlines, and daily fluctuations. Pal thinks we're approaching phase 2 of the B2022 is a major reason why this business cycle is longer than typical, lasting more like 5 years instead of 4. Due to the extension of the expansion phase, markets now have more space to grow. The notion that we are still in the early stages of the expansion cycle, providing long-term investors with a unique chance prior to the next significant correction, is supported by current macro data such as interest rate patterns and ISM readings. Based on previous cycles, Pal recognizes recurring patterns. Altcoins rise when Bitcoin stabilizes. Liquidity propels inflows and Bitcoin leads initially. With 12 to 18 months of possible upside ahead, the pattern indicates that we are still in the early stages of this bull market. Pal contends that Phase 2 is designed to weed out the impatient and reward those who comprehend the macro dynamics at work. Even though volatility will persist and many traders may see pullbacks as the cycles end, as Phase 2 develops, investors should now concentrate on watching capital flows, keeping an eye on liquidity trends, and getting ready for acceleration. The message is straightforward. Be patient, pay attention to macro signs, and prepare yourself for the next phase of the cryptocurrency bull run might already be underway.